Let's bring in Myles Zyblock right now, RBC Capital Markets. Myles, good noon to you.
Hey, Tom, nice to be here.
When you look at the year, when you look at the frustration all investors have, whether they're sophisticated hedge funds or there are many of our viewers who have been up, down, and whipsawed, what of volatility next year? Will we be calmer next year?
No, I think that that volatility is going to stay elevated, honestly, into it's first half of the year pretty calm, and then dividing line in the second half of the year, and volatility has been pretty elevated. I think it stays elevated well into the first half of 2012, and the reasons are there's a lot of things that are unsettled business. I mean, we still don't really know how to address the sovereign issue in Europe. China looks like it could be buckling here a little bit. Its growth profile, this market definitely is, and at home we have some confusion and some policy gridlock, and we don't know where DC is going with their programs next year.
Is that just a public policy issue? This payroll tax flap, does that have any bit of the size or mass of the debt downgrade, or is it just a political backstory?
I think it's a political backstory. I mean, the real issue right now is, we know we have a long-term debt problem. We all understand that. But in the shorter term, when our economists are thinking you might only get 1.5% to 2% GDP growth next year, if a lot of these programs are allowed to sunset, these transitory programs are allowed to sunset, you could easily clip a percentage point off of GDP next year. And when you're only starting with a base of about 1.5 to 2, it turns into a pretty challenging environment pretty quick. We just have to know where we're going with this.
Here's a chart. We've shown this many times this year. What a privilege to meet Roger Ibbotson the other day. He will be on the show next year. The Dow across 9 decades. I call it the Ibbotson chart. Semi-log. Even with the financials out, it's been a challenging decade, Myles. Do you see more of a range-bound decade or a range-bound 2 or 3 years, or can we really get some pop in 2012?
Yeah, I think 2012 is going to be sort of a replay of 2011. Maybe once we get the stimulus going in the rest of the world, that could help the foreign-sourced earnings and maybe give us a lift at that point. We're just starting into the easing cycle. It takes time. If you look at the longer term, like you said, when you're in these big range-bound markets, I think we've been in one for 10 years. What we do is we have a long-term forecast as well as shorter-term forecast. Our long-term forecast for the S&P is to total returns all in are 4.7% annualized over the next decade. Total
return is 4.7%? Is that what I just heard?
Annualized.
Yeah, Sarah Silverstein, banner that, please. That's an ugly number. Okay, let's stop. We're going to rip up the script here. 4.7% annualized means you can't get your retirement plan done, right?
It's going to be difficult, absolutely. Yeah.
When I visited Darden School, they're looking at a 5%, which is close to 4.7%. Real return. You're talking about a nominal return of 4.7% or real?
No, nominal.
It's an incredibly cautious field.
I mean, it's yeah, sorry, Tom, go ahead.
Well, bring up the value line geometric. Sorry to interrupt there, Myles. This is a distressing chart. This needs to be explained, folks. This is not a normal stock series. I love this series. It's from 1 million years ago. The value line geometric index, where it takes a price change by the product or multiplication and not by arithmetic series. It's a more cautious view. And you could see how we've gone nowhere over the last 10 years, and it puts into better measurement that move upwards that we had in the 1990s. It has been a real struggle, Myles, for the last 12 years. What will earnings do, or what will cash flow generation do to get us out of the geometric muddle?
I think it's just a workout period. We're still living off the 2000 highs in valuations. I mean, if we take normalized earnings estimates to be, we have a cyclical earnings estimate for 2012, just like everyone else does on the street, and we have a 4.5% increase in earnings for 2012. It gets us to $101 versus the consensus, bottom-up consensus, about 108. But if you look through the cycle and what I think is more important for the long term, normalized earnings, where you don't give any credibility to the cycle at all, but you give all your credibility to productivity growth and population growth, you can't get much more than 6.5% on-trend earnings growth over time. And with that kind of idea in hand, Normalized earnings, the look through the cycle idea is $69. And on normalized earnings, the stock market doesn't look all that cheap. It's just reality. I'm just trying to be a realist here, Tom.
Good. Emily, we're never booking Myles again. Let's bring up this op-ed here. John Taylor has got a new book coming out. Want growth, try stable tax policy. Demand is low in part because firms are reluctant to hire or to invest, not knowing what tax rates and other provisions will be. Demand for investment will increase if policy unpredictability is reduced. Myles, your grim view of 4.7% total return, how much of that do you blame on Washington?
I blame a portion of it on Washington. I blame a portion of it on the Federal Reserve's past policies. I mean, what the future is about is not about what we're doing, it's what we did over the last 15 to 20 years. And I think this is the workout period, whether it's the deleveraging, whether it's the deficits and the debt problems. I think they're all interconnected, and I don't think there's any one particular side of the policy equation that's to blame. I think there's contributors right across the row.
I want to bring it over to bonds and how they fold into equities. Myles, what is the linkage right now of bonds to equities? Are they tightly correlated? Are they typically correlated now?
Well, I mean, they're atypically correlated. I mean, what you've seen, well, let's just rephrase that. Bond yields and stock prices are positively correlated. So bond yields rise when stock prices rise. I don't know if it's causal. I think it's, better growth outlook is lifting both assets, or yields up and stocks and vice versa. And this has been the case since 1998, and it's kind of atypical if you look back the last 100 or so years where bond yields and stock prices become positively correlated. The only times we generally see that are in very, very low inflation periods, like in the 30s or like in Japan.
Right, well, that's where we're in now. Look at this chart, folks. Too much information. Thanks to Eric Van Nostrand and the team at Credit Suisse for this. Myles, I want you to comment on this. Credit Suisse has an outlier call of a 1.5% 10-year yield early next year. They forecast the 2-10 flattening of the yield curve down to 125 basis points, which is that red line on the chart, folks. That would be an incredibly flat yield curve. If we get that, Myles, what does a flat yield curve do to the financials? What does a flat yield curve do to equities?
I think already we're seeing that the financials, they're trading directionally with bond yields. They want higher yields, and there's obvious reasons why. Net interest margins, there's asset liability mismatches on the insurer side. I think margin compression would be a bad thing, again, for banks that are already facing a lot of obstacles. And the same thing, lower long-term yields would be very troublesome for a lot of the insurers as well that have long-lived liabilities. So
what is the direction?
Yeah, if that's the call.
What is the direction?
If that'd be tough.
What is the directional of Michael Clority, and does he suggest we can go far under a 2% 10-year?
No, I mean, our fixed income team says, we're already pretty much stretched on valuations. Maybe we get a little lower. I'm not sure the 1.5% is in Mike's mind. They think outside of, no Europe. Let's just say abstracting from Europe, they estimate that Europe accounts for about 80 to 100 basis points in the 10-year Treasury. So the flow of funds, the sort of into safety has compressed yields maybe 80 to 100 basis points more than otherwise would be the case. I don't know. I don't think 1.5 is in their thought process.
Let's show the trend of this, folks. I love this chart. It's maybe the chart of the year. We took the 10-year yield, went back to 1985, and then zoomed in through the decade, and you can see the great moderation, the great disinflation, and down we go with financial repression underneath that. And there's a collegial debate where the 10-year yield will go. Myles, where will the equity markets be a year from now? Where will the Dow be?
I think they'll keep pace with earnings. I think PEs are basically anchored because of all the uncertainty, both political and economic uncertainty. So I'm saying anywhere sort of around 4% is where our earnings is. Our earnings target is for 2012. If you can get 4% out of the market plus a dividend, that's where I think we're going.
Myles, thank you so much. Myles Zyblock, RBC Capital Markets.